Hi, everyone. Stan Reinford. Welcome to this week's market update. This is take two. First time my computer decided to shut down before it recorded. So let's jump into it. So, again, thank you for all the great compliments, conversations, pointers, questions. Really, really appreciate it. So, we have a lot of new people joining this week, and we have some questions from them. And then we also have some questions from some that have been viewing this for a little while. So, let's explain this. We have three boxes at the top. To the left here, we have the 30-year Treasury, which you'll see it's green and it's 11 BP or basis points. So we were up today, and I'll explain why we were. And the middle is the 10-year Treasury. And then to the far right here is the S&P 500. We're looking mostly at the 30 and the 10. We have the candlesticks down below. A green candlestick means that rates got better or went down or stayed the same. And the red means rates went up or they actually stayed the same. So today, all the way to the right, you'll see that we went a little higher in the chart, which means rates went lower slightly, just slightly. And then we've actually come up to the highs of where we are, almost at the highs of where we were at the last meeting. So we're getting darn close. We got to get down here to 4% on the 10-year. We're just above that at 4.06 to be at those lows back on October 29th. So let's kind of jump into it. Today, the reason that we're green is the highly expected jobs report, or ADP jobs report, was supposed to show that there were 10 to 40,000 job gains. Instead, it showed that there were 32,000 job losses. So really, 72,000 or so less than what was expected, if you really look at it that way. Over the last 4 months, there's been 17,000 job losses on average each month, which is showing huge weakness in the labor market. If you look deeper in the report, 120,000 job losses occurred in the small business area. Remember, small business is more than 50% of the workforce out there. So that is showing an indication and usually shows earlier signs than anywhere else that there are problems in the labor market. The highly expected BLS reports that have supposed to have been coming out, as I think I mentioned last week, they were talking about them not coming out and not being reported until after the next Fed meeting. That has been confirmed. It will not be reported until December 16th. However, many believe that that's actually a good thing because the BLS usually does not do a good job in measuring the small businesses. So that would not have shown where we are today in reality. So Black Friday sales. So Black Friday sales, they actually showed a record $12 billion in sales, up 9% from the previous years. They're showing more online activity than ever before, which means people are leaving the stores, although you would not have known it on Friday when you listened to the news and watched and drove past these places because they were so packed that it was, you couldn't find a spot and there were people, sitting on the roads trying to get in. Let's talk the next Fed chair. So the other day, Scott Bessent, our Treasury Secretary, announced that the president has chosen who that's going to be, and it's supposed to be announced before Christmas. Many believe it's going to happen any day now, so we'll have to wait and see. There are three main candidates for that: Christopher Waller, Kevin Warsh, and Kevin Hassett. The person in Washington that usually leaks the information, Nick Timiraos, believes that the next Fed chairman is going to be Kevin Hassett. Kevin Hassett has been a longtime advisor to the president and other people in Washington, D.C., and the markets also believe that he is going to be, because when this was announced, it didn't react negatively, and the markets like him. So again, just giving you the news there. And then the next Fed meeting is December 10th, 1 week from today. As you know from last week, as I was mentioning, the closer we get to the meeting, it's a higher chance that the Fed is going to reduce the Fed funds rate by a quarter. Remember, Fed funds rate has no bearing on mortgage rates, none at all. What it does is it signals what's happening behind the scenes. In fact, as we lead up to the Fed meeting, we usually have the lower rates. As soon as the Fed meeting happens, within minutes, hours, then interest rates usually retract and go up a little bit. So just keep that in mind. Historically, the last year, 2 years, that's what's happened. So interest rates. Interest rates, if you're looking to find out what they are, I've had lots of inquiries on those. If you are purchasing a home, primary residence, putting more than 30% down, chances are you could touch the fives in somewhere around 5.99, 6%. If you're looking at putting less down and maybe even have some credit scores that are a little bit lower than normal, you might be looking in the low to mid sixes. If you're looking at taking a cash out refinance, you're probably looking in the upper sixes because they usually have a little bit higher interest rate on those. So, again, I'm here to help you, whether it's for you, your friends, your family, your coworkers, whether they're looking at buying or refinancing, whether it's a home equity, renovation loan, owner occupied, second home, or investment property. I can help you with all of those. And if you have if you're self-employed, we have lots of different self-employed loans, or you need down payment assistance, we have loans that can help you there. We even have one loan where you do not have to be a first-time home buyer, and there's no income limits to be able to provide you with some down payment and closing cost assistance. So again, have a great one. Please forward and share. And if you have any questions at all or have any specific questions for you where we should jump on a call to help you specifically, call me, shoot me up a text. I'll be happy to help. Take care.